Welcome to vTalkInsight, Market Drivers Daily for April 3rd, 2026. An historic oil squeeze is colliding with stronger than expected U.S. payrolls, forcing equities, rates, and credit to reassess the balance between growth resilience and stagflation risk. Let's unpack how the energy shock, the soft landing debate, and the latest growth surprises fit together in today's macro picture. The energy shock has now morphed into a full-blown physical supply crunch, and the scale matters for every macro call on inflation, growth, and risk assets. Spot crude benchmarks have surged to levels not seen since the late 2000s, with dated Brent pushing above $140 and some physical cargoes reportedly changing hands well north of $150. At the same time, West Texas Intermediate has jumped around 11% in a single day, underscoring how tight prompt barrels have become as buyers scramble for replacement supply. The stress is even more visible in refined products. Diesel and jet fuel shortages are acute in Asia, with Singapore benchmarks trading above $250 a barrel, raising the risk that some economies are effectively priced out of essential energy. A lack of available tankers, amplified by disruptions around key Gulf shipping lanes, has pushed freight costs up by roughly $10 to $20 a barrel. That is choking off some United States crude exports despite attractive prices, building inventories at home even as import-dependent regions struggle to secure supply. Geopolitics around the Gulf are locking in this tightness. Escalating attacks on energy infrastructure in Kuwait and the United Arab Emirates, including a major gas facility, highlight how vulnerable regional production and export capacity have become. The first Western cargo ship has transited the Strait of Hormuz since the conflict began, but Iran is tightening its grip by imposing new protocols and tolls, and market participants do not expect traffic to return to pre-war volumes during April. Efforts to degrade Iran's missile capabilities have had only partial success, and the United States is threatening further strikes on energy and transport assets. So both an escalation and a fragile ceasefire look negative for supply in the near term. Against this backdrop, buffers are being run down quickly. OECD emergency stockpiles are projected to fall by roughly 1 billion barrels over the next 2 to 3 months, a historic draw that could force uncomfortable decisions on further releases. European officials are already preparing worst-case plans, including rationing and deeper use of reserves, while Southeast Asian economies, such as Thailand and Vietnam, face serious downside risks to GDP as they struggle to afford critical fuels. The combination of tight physical markets and declining stocks suggests spot prices may need to stay far above what futures curves currently imply, raising the odds that elevated oil feeds into a more persistent inflation backdrop. So far, the full energy shock does not appear fully embedded in risk asset pricing. Volatility is elevated and there are signs of de-risking, but many assets still trade as if the disruption will be short-lived. If high oil coincides with a loosening labor market, credit spreads look vulnerable and outflows from riskier segments could accelerate. Core personal consumption expenditures inflation is now tracked around 3.6% for the first quarter and near 3% in the second, and persistent supply shocks could keep those numbers sticky, keeping stagflation risk firmly on the table. There is, however, a counter-narrative built into market pricing. Oil futures curves show a steep decline over the next 12 months, reflecting the belief that current disruptions will ultimately prove temporary. United States officials also expect the domestic economy to weather the storm better than in past oil shocks, helped by lower energy dependence and the ability to raise exports and waive regulations when needed, even though drilling activity has not yet responded meaningfully to higher prices. If the conflict eases within the next few weeks, that normalization view could prevail, but a prolonged squeeze would challenge it and deepen the macro damage, setting the stage for the broader soft landing debate. Beneath the energy shock, the core cyclical story still looks like a soft landing, but with rising downside risks concentrated in incomes and credit rather than headline employment. In March, overall job creation was strong, yet aggregate income growth was essentially flat, and hours worked and wage gains have not kept pace with employment. That points to declining discretionary income and early signs of demand destruction, particularly as fuel and other input costs rise. The labor market signal itself is noisy. Over the past year, job growth outside healthcare has been negative, and some measures show first-quarter payroll gains averaging only around 30,000, barely enough to keep unemployment from rising. The labor force shrank by nearly 400,000, driving participation to its lowest level since late 2024, and high-frequency job posting and survey data indicate weak hiring plans as firms prioritize cost control. At the same time, the unemployment rate is still near 4.25%, and private payrolls have been growing at roughly 79,000 per month, which can be sufficient to stabilize joblessness given slower labor force growth. This backdrop is feeding into both credit dynamics and rates expectations. Private credit vehicles are seeing elevated redemption requests and gating, and spreads are likely to move wider, but capital availability remains solid, and the stress so far looks more like a liquidity adjustment than broad deterioration in economic activity. Across public markets, positioning and survey data suggest participants are more focused on a potential growth shock than on a runaway inflation shock, with a clear bias toward expecting lower 10-year Treasury yields if momentum fades. That skew means downside data surprises could have an outsized impact on rates and risk assets. For now, the base case remains a slowdown without a formal recession, but it is fragile. Strong headline payrolls, flat incomes, and patchy participation paint a picture of a stable but gradually loosening labor market that is highly exposed to further energy and credit tightening. Market reaction is also asymmetric, with Middle East tensions likely to make participants respond more aggressively to weak jobs or consumption data than to positive surprises. Watching the next few prints on wages, hours, retail sales, and credit spreads will be key to judging whether the soft landing narrative holds or whether the current upside growth surprises prove more durable, which leads directly into the question of growth acceleration. Set against the energy shock and soft landing concerns, the latest U.S. data flow has delivered a clear upside surprise. March non-farm payrolls came in around 178,000 versus a consensus near 65,000, the strongest reading since late 2024, and the unemployment rate has dipped to roughly 4.3%. Taken together with robust retail sales and low jobless claims, this points to an economy that is still expanding at a healthy clip rather than sliding toward recession. The sources of that momentum look relatively broad-based. Recent readings across retail, spending, business surveys, and alternative labor indicators have consistently beaten expectations, pushing economic surprise indices to their highest levels since late 2023. Corporate behavior is aligned with that story, with merger and acquisition activity and initial public offering plans picking up as executives plan for continued growth. Structural forces, including large-scale investment in artificial intelligence infrastructure, industrial policy support, tax cuts, deregulation, and even larger tax refunds, are all cited as helping to sustain demand and support an outlook where GDP growth could run near 4% if geopolitical tensions ease in coming weeks. Markets have reacted, but in a nuanced way. Treasury yields moved higher after the jobs report, with the 2-year rising from about 3.81 to 3.85%, and the 10-year climbing to roughly 4.35, signaling expectations for a stronger economy and later rate cuts. Yet the overall response in risk assets has been muted to slightly negative as energy and geopolitical risks overshadow the good news. The Federal Reserve is widely seen as staying in wait-and-see mode, balancing upside growth data against war-related uncertainty and volatile oil, and only moving toward rate cuts later in the year if oil-driven shocks persist and financial conditions tighten meaningfully. There are still important challenges to the growth acceleration narrative. Net payroll revisions have been negative. Hiring is heavily concentrated in sectors like healthcare and education, and wage growth and hours worked are not matching the headline job strength, all of which question how long current momentum can last. At the same time, many investors have already shifted toward risk-off positioning because of the Middle East oil shock, and markets remain more sensitive to potential growth disappointments than to positive surprises. The key watch points now are upcoming payroll and wage prints, the path of oil prices and shipping disruptions, and the Fed's communication on how it balances strong activity against persistent supply shocks, which will shape how far this growth phase can run. The picture coming together today is one of severe energy dislocation, a fragile soft landing, and surprisingly resilient U.S. growth, all pulling markets in different directions. Physical oil shortages and Gulf tensions are keeping inflation tail risks alive, while flat incomes, cautious hiring, and private credit stress highlight downside growth vulnerabilities even without a clear recession signal. At the same time, upside surprises in payrolls and broader activity data are pushing yields higher and forcing a rethink of how quickly policy can ease. Watching the tug-of-war between the oil shock and the growth pulse will be critical for any cross-asset allocation decisions in the weeks ahead. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.